Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 111, titled Rolling Down on a Sharp Market Decline at the End of a Contract. We're going to be using a real life example with Healthcare Select Sector Spider Fund, which trades on the New York Stock Exchange under the ticker symbol XLV. Now, back in June of 2020, during the COVID crisis, the market had a huge, sharp decline in June of 2020. As a matter of fact, it was an 1,800 point decline in the Dow 30. Now, what were the reasons? Well, certainly the coronavirus concerns was on everybody's mind and impacting the market in a big way. Also, there was a lot of national unrest due to police shootings. So these two combined situation where the market felt very uncomfortable and just plummeted. Now, for those of us following the BCI methodology, we had our 20%, 10% buy to close limit orders in place after we entered our covered call trades, assisting us in automating when to close our short calls. So those were, in fact, executed because of this humongous market decline. So let's show a real life example now with XLV, starting with trade initiation on May 16th, 2020, and going through June 12th of 2020. So we're looking at slightly less than a 1 month situation that we're going to be discussing in this podcast. So on May 16th, I purchased 200 shares of XLV at 101.70, and then immediately sold two contracts of the June 19th, 2020, 103 out of the money calls, and that generated a premium of $2.07 per share. Now, immediately after executing the trade, following the BCI methodology, I placed a limit order at 40 cents, which is approximately 20% of the 207 that I received when I sold the two options. So that was the 20% threshold. So we set a buy to close limit order, good till canceled, at 40 cents. And then what happened was on June 8th, I changed that to 20 cents, or reflecting the 10% guideline we use in the second half of a contract. So that was what was on the plate later in the contract, 10% guideline, buy to close at 20 cents. Now, on June 11th, as we approached the very end of the contract, the two buy to close limit orders were executed at 20 cents, and that was due to that market decline. So those short calls were closed. The very next day, there was a little bump up in the price of these shares, kind of a little bit of a mini rebound, and I was able to sell to open to June 19th, so the same expiration date, 2020, 98 calls. So I rolled down from 103 to 98, and we sold those at $1.10. So the cost to close the original strike was 20 cents, and the premium generated from rolling down to the 98 call was $1.10. So what we did was we netted 90 cents per share, or $90 per contract, or $180 for the two contracts. Now, when we roll down, we also have to put in our buy to close limit order. So 20% of the $1.10 is approximately 10 cents. So we did enter a 10-cent buy to close limit order, even though we were nearing the very end of the contract. Now, for those of you watching this podcast, I'm showing now a screenshot of what the price of XLV, which is the purple line, I'll describe this to those of you not watching, really mirrored the price performance of the S&P 500. This was a market decline. Really had nothing to do with the individual security. And there was a huge, huge decline right at the end of that contract, and then a bump up the next day. So the Red arrow, for those watching it, represents the huge decline. And right at the end of that red arrow, you'll see a purple arrow, which reflects the slight rebound that happened the next day when I rolled down to that 98 call. Now, I'm now showing a screenshot of the actual brokerage account that I used, where you could see the buy to close limit order at 20 cents, and then selling the two contracts at $1.10, and then initiating the 10% buy to close limit order at 10 cents. Now, whenever we put in a buy to close limit order, the 20% or 10%, we always enter that as a good till canceled rather than a day only order. So it stays there until we change it. Let's just summarize now. Mastering the skill of position management will assist us in elevating our returns. You know, sometimes it's not a matter of taking a losing trade and making it a winning trade. Frequently, it's a matter of mitigating losses, as it was here in this case. Now, by putting in your buy to close limit orders after entering the trade, you're somewhat automating position management, somewhat. And it is very helpful because sometimes during the course of the day, you can't be there to see it reaching that threshold. It may bump back up again. So this way, you know, we bought it back in our position to resell another option, whether it's reselling a similar option, if it rebounds significantly, or rolling down as we did in the case of this particular podcast. Now, if it happens late in the contract, we can roll down to generate additional income, which we did in this case, $180 net credit on those two contracts. So is it a windfall? No. But $180, you do that a few times every month, you do it dozens of times every year, and it will turn out to be very significant income over the trading lifetime of the average retail investor. Before I go, let me brag a little bit about our BCI package. For those of you new to options, if you're looking to purchase a discounted package, this could be the package for you. It contains 6 online video courses with downloadable workbooks, 6 calculators created by the blue-collar investor, which means you can find them nowhere else, 5 of our best-selling books in ebook format, and an annual premium membership where you have access to all of our screening reports, plus a huge educational component of over 200 videos, and we add an additional video every month. And it's only the renewable aspect of this in 13 months is the premium membership only. Everything else is just a one-time purchase, and it's a lifetime purchase. So the ongoing and never-ending video trainings we offer in the membership includes the Ask Alan video library, where we break down trades from either my portfolio or from those shared by our members. And we really break down and analyze all these trades. We have a detailed, in-depth section for our Blue Hour webinar series. We add a few every year. And for the Ask Alan, we add one every month. So each month, you're going to get at least one new training video, sometimes 2. Where can you find more information? Go to our website, www.thebluecollarinvestor.com. Look at the top, and you'll see a link that says BCI Package. We produced a video that will be instructive in everything that's included in this discounted package. Ladies and gentlemen, thank you very, very much for taking the time to listen to and or watch this BCI podcast number 111 titled Rolling Down on a Sharp Market Decline at the End of a Contract. Folks, I hope you enjoyed this presentation, and more importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.